Today's lecture, no afternoon session. We are going to explain a chapter which is, according to my opinion, very interesting. It is one of the favorite topics to me in financial analysis. But before we start with explaining the new chapter, please, only for 2 minutes, let me share my screen. Well, with what I have here, the Moodle page. I hope that you can see the Moodle page over here. Just to let you know, in case you didn't check yesterday, just for you to know that we have posted the previous exams. It is right here behind the slides and other materials. You can find a new section, and that is exams of the previous years. Of course, I posted there only the first exam that happened on November in 2020, and then the retake exam on January. January exams are basically the same structure, the same kind of questions and exercises, just with different figures and amounts. So please have a look at these exams over there. I'm not saying that it's going to be the same thing, but the structure will be the same. We will have true-false questions, we will have multiple choice questions, and also exercises. Obviously, the most important part of the exams are the exercises, because you have to show your calculations and to show your solutions. Also, some guidance on the final exam was posted yesterday from Professor Alberto. So you can have a look at that and you can know what we expect regarding the organization of the exam. If you have your own device, your own computer, you are welcome and you are free to bring that into SA at the day of the exam. It's going to be probably in the morning. I still have to check with Professor because she will be in charge of managing the exam in SA. So if you have your own device, you can bring it and you can work from your own device in one of the rooms, because the lab only has 30 computers, 30 working posts. So this is the situation. Of course, you can take your exam from home, but in that case, you cannot go back and forth through the questions. And you know that that's a big drawback. So I strongly encourage you to take the exam at SA. Therefore, please let us know through the form that is there how many of you are thinking to come at SA with your own devices, or will you be working at the lab? So again, regarding the final exam, you have some exam from previous years posted there. In case you need to ask any question, just feel free to write to me, or just you can write through email, or maybe you can write something in the chat right now. Okay, something else that I wanted to share regarding the materials posted on Moodle, regard the group work presentation of part 2. I've posted also a material which is a kind of guidance you can find helpful while you are preparing the group work, and also while you are thinking to present the group work. You have here some important information regarding the topics that should be included in the contents of the group work presentation. So more or less, these are the expected contents that all of you need to cover for each of your own companies. Of course, these are things that we have either discussed until today in our lectures or will cover in the coming hours. For example, information on inventories or the segments or the cash flow statement. Continuously, I have provided some guidance at the very last slide of each chapter. But right now you can find here summarized everything that covers the second part of the course and needs to be disclosed in your second group work. So this is the topics and contents that you should involve there. There is no limit, minimum number or maximum number of slides. There is nothing like that. It's enough for me if you can cover everything that is in the financial statements and you analyze them properly, calculating the indicators and providing the necessary interpretations, and you arrive in a conclusion about the performance of the company and also the expected performance in the future. If you can do that, it's fine, whatever the number of the slides is that you included there. So no minimum or maximum number of slides, just for you to help and focus in the contents of the presentation. Then something else that it's important is that you will have 10 minutes timing, each of the groups, so more or less 2 minutes each of you. Please be brief. Do not say anything or do not explain everything it's in the slides. We can read them. You just focus on the most important stuff you have to present, okay? And then maybe we will have some questions for you. So 5 minutes is the time for the instructors, me and Professor Busso or Professor Alberto, if they join, to make any questions. The presentations will be on Friday, 5th of November, and I have included a tentative draft schedule of the timing. I can perfectly understand that there are a lot of factors that probably will make it not possible to follow this schedule. For example, some of you have health problems and maybe you cannot join in the allocated time slot, or maybe you cannot come and join in SA at that day. Actually, I strongly encourage you to come and physically be at our class and present your group work by being there. Why is that so? Because you will make a better impression on the instructor. You will be able to present yourself in a better light if you come and make the presentation in the class. So it will be better for your assessment needs if you come and make the presentation in the class. And that will also not cause any delays for the other participants and members in the group. So I strongly encourage, if it is possible for you to come at the SA, please do that. In case you need to change the time, it's not proper for you, or you cannot come for whatever reason, you cannot join at that time, but you can come earlier or later. I advise and I suggest that you discuss with some other group. Maybe you know the members and participants of another group, and maybe you can swap together. For example, if group 6 cannot make it at 10:30, maybe you can swap with group 15 at 14:15. So maybe this is an idea how you can manage the time. But still, in case you have any problems, please let me know through email, and maybe we can think to find a solution. Again, to summarize what I'm saying, try to be at SA while you are presenting the group work. I know that it's a big deal to come in the conditions that we are, but it's important for you to make a good impression and to have as much better assessment of your work as you can. So please try and join us at the class. In case there is a very strong reason you cannot do that, please let me know and we will try to find something to do about that, okay? So this was what I really wanted to share with you before we start. This is important and necessary information regarding the yes, in the schedule we have lecture and tutorial. Yes, the presentations actually are happening during the day, Maria. We added one tutorial this week. As you saw, we adjusted the schedule. I'm trying to read all your messages in chat. We adjusted the schedule so we can have one more tutorial this week. And that means that the tutorial for the 5th of November is going to be at our it will be available for the presentations. This is one reason why we added a tutorial this week. So next week, the afternoon hours will be available for the presentations. And by 5th of November, we have probably almost finished explaining the new chapters. So it's going to be for the presentations only. Okay? Erika, no penalty. Any wrong answer means that you will have just 0 points. No penalty for that. So please, for whoever is asking, because there are also several other students asking through email, you are not going to have any penalty for wrong answers. Okay, so just 0. And again, if you saw the structure, if you saw the contents of the previous exams, you perfectly could see there that the questions, true or false or multiple choices, they were questions that we already included in our previous presentations. Every time that I put a test question somewhere in our chapters, I mention to you that please be advised that this has been a previous test question. So you know now what to expect regarding at least the theoretical part of our course. True false questions or multiple choices. Whereas regarding the exercises, I also have to mention that you probably saw they are similar to the exercises that we have covered in our tutorial. The exam is on 9th of November. So 6th is, if I'm not wrong, it's Saturday, and the exam is on 9th of November. Okay. I don't know about the time yet, in the morning or in the afternoon, because we have to arrange the classes with SA. So this is why we are asking from you to fill the form, so we have a clear idea how many students will be at SA, so we can arrange the class. And that depends on the schedule of other courses that are there. So please make sure you complete the form as soon as possible, so we can arrange with SA and know when we will have the exam, in morning or at the afternoon. Okay? Any other question? I know that the final exam is approaching and the second presentations are coming, and it's all very exciting. In case you have any other question, please let me know about the organization components, not about the new lecture today. Okay, it seems like it's all clear. With your permission, maybe we can continue and explain our new content and new chapter for today. Well, I'm not sure about that. I think that will be 2 weeks after the second dose, but that's not me to decide. So maybe you can better discuss this with the secretary. Maybe Julia or Marilena can help you. I don't know. I'm not sure about that. I don't want to give you false information. As far as I know, it should be 14 days after the second dose. But still, you have please discuss that with Marilena or Julia from the secretariat, okay? Thank you. So we can continue. I think that you can all see in your screen the presentation of the 8th lecture that we have together, and that is chapter 29 in your textbook. We are going to cover in this lecture today the whole chapter, and that is the basic ratio analysis. What ratio analysis means is that we are not going to talk anymore about specific items in the financial statements, or neither about whole financial statements like cash flow statement. We are going to focus on how to use the information in the financial statements to assess the performance of the company. That means if I have the statement of financial position, and I have the statement of performance, and I have the cash flow statement, I also have the statement in changes in equity and also the notes to the financial statements. How can I arrange the figures and the items that I read there in order to understand what's going on with this company? Is it in a better position than it was the previous year? How it's going on with the performance, liquidity, the structure, and so on? These are things that we will try to answer today through using a very specific technique of financial analysis, which is ratio analysis. Basically, what we do, we combine in a mathematical form ratio, having a numerator and a denominator. We combine two different items from financial statements, being that the balance sheet or the income statement. We combine them together to calculate a meaningful ratio that will say something about the activity and performance of the company. So basically, this is what we are going to do today. Of course, we are going to illustrate the ratio analysis by focusing in one of the companies that you have been provided since the beginning of this course. For today, I decided to illustrate the ratio analysis by using the Carrefour financial statements. So by the end of today's lecture, after we theoretically discuss about ratios, we are going to specifically look at the ratio analysis of Carrefour company and see how we can perform that. You are expected to do the same thing with your own companies later. So, which are the learning objectives for today? We will first remind ourselves which are the needs of the users of the financial information, how they make use of the financial and accounting info that is provided to them. So this is identifying the needs of these users is the first objective. Then we will explain the technique of ratio analysis and how to calculate appropriate and meaningful ratios. Of course, not everything that we can combine together, taking two whatever random items from financial statements, they do not necessarily represent a meaningful ratio. So how can we calculate meaningful ratios, appropriate ratios? Then we are going to explain what each of these ratios means. And of course, we will mention their limitations. None of the financial ratio is perfect. They all have their pitfalls or drawbacks or disadvantages. When are the cases and the limitations that I have to keep in mind whenever I interpret the value of various ratios? And then we will going to identify additional information that users may require to aid in their analysis. Sometimes we need to have information from the sector or industry where the company operates. Sometimes we need to have information beyond the financial data, probably some qualitative information about the number of employees and so on. And that will give us like a context or a background against which it will be easier for us to calculate and interpret financial ratios. Okay, so these are the learning objectives. Regarding the contents, very briefly, we are going, as we said, to mention accounting information and the users that are interested to use the accounting information. How we can use benchmarking in analysis. As we said, we need something against which to compare the ratios that we calculate. Which are the benchmarking? Which are the standards that I will use to have a proper interpretation of the ratios value? And we are going to mention over here several benchmarks that we can use in our analysis. Then we are going to jump at the technique of ratio analysis. There are several of them. We can calculate ratios and also combine them in what we call the ratio pyramid. It's like a scheme or a diagram that helps us to combine together different ratios and also connect the ratios to each other in order to better understand what each of them is trying to calculate and trying to bring to light and show about the company. That is the pyramid of ratios. And then the next item is additional information that we can use to support and to provide more background to the interpretation. So first of all, what is the accounting information and its users? As far as we know, and we have mentioned several times in our course, accounting information can be used by different users for a variety of decisions or different needs that they might have. For example, whenever the investors may decide to buy, to hold, or to sell the common shares or the preferred shares, or if in a certain moment they decide to convert preferred shares to common shares, they need some data or they need some information in order to make this decision. Is it more profitable for them to have the securities in the form of preferred shares, or is it better for them to convert them into common shares? That will depend largely on the price of the share in the market, that is an available information in the market price share, but also that will depend on the internal financial information. What can we see? What is the profit of the company? What is the amount of total assets? What is the liquidity? Can company actually pay dividends in cash? Does it have enough liquidity to do that in the future? So in order to take a decision about the shares, whatever it is, buy, hold, sell, transfer, or convert from one type to the other, I need some information, which is not only the market price, but also some information that relates to the financial statements and the potential of the company to properly cover the dividend needs in the coming years. Another thing is to assess the accountability of management. That means to assess if the management have been successful in their decisions or not. The management are entrusted by the shareholders to manage their resources and their property. And right now, we can use accounting information to assess and understand if the management, if the higher level managers, if they have been successful in their job or not. Do they deserve the bonuses that they are taking or having are allocating to each other, or they need to be held responsible for some wrong decision that probably they took. So assessing their performance is also done based on financial information. Assessing the ability of the entity to pay and provide other benefits to its employees. In case you are an employee to a big company, you want to understand if this company is successful, if it is going to be in the market for many years more, so you will have your job. And so you can understand this by reading the financial numbers and by understanding if the company is having enough profits or not. So another use of financial information. But also assessing the security for amounts lent to the entity. This is the creditor's perspective. If you have been lending money to this company, you are a creditor and you want to know if you are going to take back your investment in loans or in bonds. And you understand this by analyzing financial information and by understanding, has this company actually solved the potential to cover the debt expenses or not. So these are some kind of information that we can mention, but also there are other needs that and other purposes and uses of the financial information. Other needs that we may briefly mention are the determination of taxation policies. The government needs information about the corporations operating in its territory or regional geographical areas to determine which is the proper tax policy to follow, to increase the value-added taxes or to increase the income taxes and so on. Also to determine the distributable profits and dividends. Before the company takes the decision to assign dividend or to distribute dividend to its shareholders, it needs to understand if it actually has the capacity to distribute dividend, has it made a profit or not. Preparing and using national income statistics. Usually, every country has its own statistical agency. The European Union has the Eurostat, and the Eurostat is the agency in charge to collect statistical information and to provide summary reports for the interested parties. In case you want to know about the EU statistics, you can check the Eurostat webpage. But where do they find this information is the financial statements of the corporations. So whatever they prepare and report, maybe they also file and submit to the national statistical agencies, and they take this information, aggregate, and they come up with some summary statistics that are really helpful. For example, the average income in the construction sector or the average profit in the banking sector. How do we have this information ready is due to these statistical agencies that I'm mentioning. Every country has its own statistical agency, and the European Union also has one. So we can have this summarized and representative information from different sectors and industries. Also, another need is to regulate the activities of the entities. Sometimes it may become clear that some of the entities are operating in fairly higher margins. That means that they are having a high profit, selling at very high prices their product. And sometimes the government may intervene and regulate the prices, especially if it is related to some sensitive sector. For example, providing energy or providing another public utility like water or sewage systems. What are the companies charging the citizens for these services? Sometimes this becomes really apparent from the financial information, and then the government may intervene and regulate the prices, regulate the profit margin of these companies so they will not exploit the citizens and so on. There are three actually general areas, or you can see them like three dimensions probably on how we can use the financial information. First of all, the first dimension that I need to understand is the performance of the company. How successful is this business? Is it making a reasonable profit? Because I may find a profit in the income statement, but is it enough for a company operating in this specific sector? Is the company utilizing the assets to the fullest and the maximum potential that they have? And the asset utilization ratios are very important so we can understand if the investments are being used at their proper expectation rate. Is the company profitable or efficient? This is what we are trying to understand through the first dimension or the first set of ratios, the ratios that are related to the performance. Again, this set of ratios tries to understand if the business is operating at a profit, if it is utilizing its investments at the best potential or not. So this is something that we will learn how to assess and interpret for the companies. The second dimension, that is the second part that we are going to discuss, relates to the financial status. That means that can the company pay back its debts or not? And whenever we mention or we talk about the financial status, we refer to the short-term financial situation, and that is known as a liquidity, and also to the long-term financial situation, and that is known as solvency. That means that each time that you hear the term liquidity, that means that in the short term, can the company pay off its debts or not? If you hear the term solvency, that is again has something to do with the repaying back ability, but for the long term. In the long term, beyond 12 months, can still the company be solvent? Can it still pay back the debt that it has collected previously or not? So the financial position or the financial status, it's very important to assess the ability of the company to be in the market for long or to going concern. If you remember the accounting and financial principle of going concern of the entities, it has a lot to do with the financial structure and financial position. And the third dimension, the third area in which we need to focus when we assess the performance of company is the investment perspective. That is, if we see the company not as simply analyzing the performance and liquidity and solvency, but assuming we are potential investors and we want to buy shares in this company, which are some of the most useful ratios that we use to compare companies to each other and to choose which is the best investment we can make in the market. So the third category, the third class of ratios, it's going to have a specific point of view, and that is of the potential investors. Okay, so remember three classes: performance, financial structure, financial status, and investment as well. First, before we begin to explain what ratio is actually included in each of the classes, let's remind ourselves that we need some kind of benchmarking. That is, we need some kind of standard against which to compare the value of the ratios that we are getting. Assume that we calculate the net profit margin 20%. Okay, I need to compare that to something. Is that enough? Is that low? Can it be higher in the future or not? So I need a kind of benchmarking, a kind of standard against which to compare what I find through my calculations. In financial analysis, actually, we can use different benchmarking tools. And actually, the three general areas of interest, performance, financial structure, and investment, they provide answers that may be quite subjective. Whenever you try to understand what does that mean, that may mean a lot of things. So you need this standard against which to compare. And these are known as benchmarks. And we compare current performance and financial status and investments. We compare to the benchmarks that we are mentioning. Usually in financial analysis, we can use one or all of these four benchmarks. So again, the more I have, the best it is. Sometimes I can have only one benchmark available as data. Sometimes I can have two or three of them. Sometimes I can have four of them. So what each of them means. The first one is past period achievements. That means that whatever is the ratio that I'm calculating, maybe I can compare that to the same ratio for the previous year. For example, the profit margin that I mentioned is 20% in 2020, but 2019 it was 30%. So it means a decline, it means a decrease regarding or comparing to the previous period. That means that most often than not, we are going to have the first benchmark, we are going to have that at our availability. Usually, as you saw, the financial statements of companies are prepared and reported for at least 2 financial years. Some of them, you may have seen, have 3 financial years data. That means that whenever you calculate the ratios, you will almost always have the possibility to calculate the same ratio for the previous year and to make a comparison between them. What is the trend of a certain indicator? It is increasing or decreasing, and what does that mean for the performance, financial structure, or the investment perspective? Another possible benchmark is the budgeted indicators or the budgeted targets. I would say that this is something that we usually do not have. In our financial analysis, we are almost always in the position of an outside analyst. That means that we are not part of the companies that we are analyzing. We are not employees there. We are outside of the companies, and the only access that we have to financial information is the annual report that we see in the websites. That means that in this annual report, I would generally not find the budgeted information. That is what the company wanted to achieve in the first place. The budgets are usually not required to be included in the reported financial information. Whenever you are an internal analyst, that means that you work in a company, you can have access to the budgets and you can for yourself compare, for example, the net profit margin of 2020, the actual one, with a budgeted one. For most of the companies, actually 2020 was not a good year, and most of them have achieved a profit margin which was not the same as the budgeted one due to the pandemic's effects and so on. So the second possible benchmark that you can use is the budgets. Sometimes in our position for your group projects, we do not have that benchmark because we do not have access to internal information such as budgeting. But when you are working in companies, you may work in the budget sector or the budget department, and maybe you will deal specifically with preparing and analyzing budgets and comparing the budgeted figures against the actual figures, the actual ratios. Some other benchmarking that we can use is other business achievements. That means that we can compare the activity of a certain company to the activities of companies operating in the same industry or in the same sector. For example, we can compare the results from Carrefour company with those from other retailers like Spar or like Aldi in UK. So again, we can compare with our previous period's results, the first benchmark. We can compare to the budgeted targeted ratios, the second benchmark. We can compare to our peers, to our competitors in the same industry or sector. And this is the third benchmark that we can use. And actually, companies, what they usually do when they use the third benchmark, they select the best performing business in their sector, which is the best retailing company, the one that is having the highest turnover of inventory, the highest profit margin. And we compare our results with those with the best company in the sector. So again, in our group works, it will not be always possible to compare with similar companies. Maybe a couple of you groups have other companies that are operating in the same sector, but most of you do not have. So the third benchmark is also something that probably we are not able to use in our analysis. And the last benchmark is the averages of business achievements in the same area. These are known as the industry average or the sectorial average. Again, remember when I mentioned the statistical institutes, they gather information from all companies operating, for example, in retail sector, and they calculate average income, average revenue, average assets, average profit, and they report these average indicators. Then I can extract this information from the, let's say, Eurostat in the EU level, and I can use this as a benchmark against which to compare the results that I'm calculating for a specific company. Are we operating at the level of average income or average expected ratio in our sector or not? So again, we can compare our performance with that of the previous year, with that we have budgeted or as a targeted achievement, with other businesses, probably the leader in a certain market, or we can compare with average of businesses operating in a certain sector. Let's say something, I apologize. Let's say something about what the technique of ratio analysis actually is. As I mentioned before, calculating a ratio mathematically means that we are preparing an indicator that has the form X to Y. X and Y can be whatever item from the financial statements with one condition. They are logically related to each other. That means that the X in the numerator and the Y in the denominator, they have a certain logical financial accounting linkage and relation to each other. I cannot just combine X and Y that are not even related to each other. I cannot combine them and provide a meaningful ratio. To provide meaningful ratios, we need to take two items from whatever financial statements, remember that we have 4 of them, and combine them to calculate a meaningful ratio. There are different types of ratio that try to measure or try to assess the performance in the various dimensions that we mentioned previously. The ratios that measure the performance, remember the performance was the ability of the company to generate profit and to utilize the investments or the assets. There are also ratios that try to measure the financial structure and strength and financial position resilience for the future. These ratios focus on the ability to pay the debt, either in the short run or in the long run, long term. And also we have some ratios that we are going to mention and explain that focus on the investment potential of the business. That is, some ratios that combine data from financial statements with information from market, stock market, in order to provide to the potential investors some information whether investing in this company is meaningful or profitable or not. To illustrate the technique of ratio analysis, in your textbooks and in the slides, there is this company, Serendipity company, and we are going to illustrate the technique of ratio analysis using the information from this company. But as I mentioned, this will be just to emphasize and illustrate the theoretical ratios. Practically, by the end of the session today, we are going to focus on Carrefour company financial statements and calculate the ratios related to that company. So first of all, let's learn what the ratios are by focusing in a simple example like serendipity company, and then let's jump to real world company like Carrefour is. You can see here that we have the income statement of this company. That is a hypothetical one. We start with sales and then we calculate gross profit. Now you see that the difference between sales and all these three items here represent the cost of sales. That is, the opening inventory plus purchases less closing inventory will give us the the cost of goods sold or the cost of sales. It's not mentioned properly or specifically by a name, but actually this figure over here, for example, for 2024, 389, actually is cost of sales. How do we know that? Because we have already mentioned that the cost of sales is calculated as the opening inventory plus purchases less closing inventory. Then we have the gross profit, from which we deduct the wages and salaries, depreciation, debenture interest, other expenses. Then we have net profit before tax, taxes, and so on until the end of the income statement. You see that there are the common items, the common lines that I expect to find in an income statement. Okay? What else do we have is the balance sheet or the statement of financial position. Again, we have a very simple statement over here. In a real world company, we would have many lines over there. And before we jump to a more complicated example, we study this one first. This is a fairly simple statement of financial position. Non-current fixed assets, only one item in total. Current assets, we only have inventories, debtors, and banks. Remember that debtors are account receivables or trade receivables. They are all synonyms to each other. So maybe for those of you for whom it's not clear, you want to write that down. Debtors is the same as trade receivables, the same as account receivables. Sometimes the three names that I'm mentioning here, they are used interchangeably with each other and you may become confused. Remember, it's the same thing. Debtors, accounts receivables, trade receivables. Okay? Then we have the bank account. Part of the equity, we have only two items, share capital and retained earnings. Then we have one item only on non-current liabilities, and that is 10% debentures. Remember that debentures are bonds, is the same thing. Again, please, I'm just trying to remind you that sometimes we have synonyms and we have to get used with different words for the same thing. So debtors, sorry that I'm taking some time, it's the same as accounts receivable, is the same with trade receivable. Accounts receivable, AR, as an acronym, and trade receivable, TR. Actually, debentures that we have here are the same thing as bonds. Different names are often used in different jurisdictions. In a later chapter, I think we will have like a comparison of different terminology used in different regions. But for the moment, I want us to understand each other. Whereas what we find at current liabilities, you see that there is creditors in there. Be careful. This is also accounts, what we know as accounts payable, also trade payable. So creditors are nothing else than account payable or trade payable. Why am I mentioning and emphasizing that? Because in the coming pages and slides, we maybe can say accounts payables, AP, and you should know what that is. Okay, so we have this information, basically the income statement and the statement of financial position. And we will try to analyze the performance of the serendipity company in the three dimensions. That is performance, the liquidity and solvency, and also the investment potential. As we said, the technique involves comparison and contrast each item of the financial position and the income statement of the company with the figure of the previous year. Some point of interest from this comparison is that we may want to focus in important items on financial statements that maybe have undergone huge changes, and we may want to discuss them first. For example, before I start with before I start with calculating the ratios, I may want to have a look at the figure of net income, total asset and debt, so as to have a general comprehension of the situation of the company. Before I start calculating ratios, that is a very technical job actually, as we will see. It's a very technical task. Before I start to do that, what is the situation of this company? Does it even have a profit, or is it having a loss? How much are the total assets? How much debt does it have for the moment? So these are general ideas that I may have from studying the financial statements. And what I may notice, for example, I have emphasized the changes in these slides over here. For example, we can see that the sales have increased in the current year compared to the previous year. And in the brackets, you have also the figures compared. You can see that the sales have almost doubled from one year to the other. So that is a very considerable change. We also see that the cost of sales have increased compared to the previous year, and that is associated with the increase in expenses, an increase in profit after taxes. That means that generally the activity of the company has been expanded. They have more sales revenue, they have more expenditure, and logically, they are having more profit. On the other hand, non-current assets have increased considerably. They have almost doubled as well. The non-current assets, remember, are machinery, plant, property. That means that the activity of the company has really increased during these years. We also see decrease in net current assets. That is current assets less current liabilities, but still we are going to mention this as an effect later. This is overall what I've noticed from comparing one year to the other with the companies. You will usually find this comparison already completed or used by the companies themselves. For example, when we are going to see the financial statements of Carrefour, they have already made this comparison from one year to the other for every single item of the financial statements, not only for sales and cost of sales and non-current assets, but for each item, they have compared the item value number for one year compared to the other year, and they have stated the difference right there in the face of the financial statement. We are going to mention this afterwards, but remember, something that gives me a background or something that gives me some more information about the company is what's going on with the main figures: profit, sales, expenses, assets, net current or non-current. And so I have some information before I start the calculation of ratios. Obviously, what I have to do here is a company which has been almost doubled its activity in 1 year, almost doubling the sales, almost doubling the non-current assets. This means a company which is in the growth phase. Remember that identifying the stage of the life cycle was very important. Now we have 4 stages, as you remember: introduction to the market, growth, maturity, and decline. Obviously, this is a company that is in the growth phase or the growth stage of its life cycle. So this is good to know whenever we calculate the ratios and almost when we interpret and analyze them. So first of all, let's start with the ratios that are included in the first category, the performance ratio. We start with what is known as a return on capital employed. That is, with an acronym, ROTA. Return on capital employed will be calculated as profit before taxation and long-term interest compared to net assets. Remember that the net assets are the total of equity and long-term debt. I've made explanation, small one over there. Usually, all the interest in the income statement relates to the long-term debt. That means that sometimes you have to think that, okay, I have some interest expenditure in the income statement, but which part of that is long-term? In case you do not have any additional information to help you with that, you will assume that all the interest in the financial statement, income statement, is long term. Okay, is that clear for everybody? So again, all the ratios have their own formulas and their own meaning, and you have also to interpret them. So there are a lot of ratios, and we have to learn how to calculate and interpret each of them. We start with what we know as a return on capital employed, and we compare a figure of profit with a figure of investments. How much profit are we having? And we compare this profit to the amount of the investment or the assets that we are investing in a company. Are we generating enough profit or not? That is the meaning of the ROCE indicator. We also have another performance ratio, and that is the ROA, return on assets. You see that both return on capital and return on assets, they compare a figure of profit with a figure of assets or investments. But again, they are different. Profit in both ratios is different, and also the assets in both ratios is different. In ROA, we simply take profit before taxation and interest, and that is for most of you, it's EBIT, earnings before interest and taxation, remember? And we compare that with total assets. Again, ROA, return on assets, compares the profit before interest and taxation, that is EBIT, with total assets, whereas ROCE, return on capital employed, compares the profit before taxation and long-term interest only. As the long-term interest in the most of cases is the same as the total interest expenses in the income statement, both profit figures are probably likely to be the same, but not the denominator. The denominator is obviously different. ROCE takes into account the net assets, that is only the long-term financing, that is equity, which is indefinite in the maturity, and also long-term debt, which is also long-term and excludes what net assets do not include. It is the current liabilities. They are short-term and they are not included in the return on capital employed. Why? Because what I'm trying to calculate through return on capital employed is the return on a kind of a long-term capital that I'm employing, that I'm using in our company. Whereas the return on assets is simply based on the assets employed, total assets employed by the company. Another return ratio, there are several return ratios. Usually we recognize them with a common name with ROE. Have you ever heard about the ROE ratios? Return on investment. That is the ROE that we are mentioning. Now, ROE is not only one ratio. ROE can have different manifestations, if I may say that. ROE can be 1, return on common equity, 2, return on assets, and 3, return on equity. That depends on what amount of profit I compare to what amount of investment, because ROE is return on investment. That is a measure of profit compared to a measure of investments. Now, which is the measure of profit and which is the measure of investment that I compare will give me at least 3 return ratio, ROCE, ROA, and ROE. But of course, these are only the ratios that are included in our lecture. If you read further literature, you will find, for example, return on net assets. That is another ROE manifestation or form of calculating. Okay, so we can have very well other return ratios, but we have to focus only on these 3 that we have here. Questions so far? I think it's time for a short break. Do we have any question related to the ROE ratio, return on investments? 3 forms. focusing on different profits compared to different investments. Okay, maybe you can think over that, and we get back after 5 to 10 minutes. Employed in the long run, what is the profitability that we are getting from that? And two other, like the most famous, are the ROA and ROA. Return on assets compares the EBIT, earning before interest and taxation, to the total assets, whereas the ROA compares the profit before taxes but after the interest. That means the profit after taking into consideration the interest expenditure or the financing structure of the company, but before taxing this profit to the amount of the shareholders' equity. Something that it is not mentioned in the formulas over there, but that is a discussion, is that usually when we calculate the ROA and ROTA ratios, we usually take into account the assets average number. That is the figure in the beginning of the period plus the figure or the amount at the end of the period divided by 2. That is the average net assets or average total assets or average shareholders equity. That is like something that it's good to be done whenever we can, whenever we have information. But when we have only restricted data, limited information, we can also base the calculations at the end of year figures or end of period amounts, like we have mentioned here. But remember, whenever you can, whenever you have enough information, it's better to take into account the average number of assets, the figure in the beginning plus the figure at the end of the year divided by 2. Is that clear for everybody why we take into account the average amount of assets? Okay, I see that there is no question so far. I hope that that's clear for everybody. So regarding the company that we are taking as an example, we calculate the ROTA and ROA for both years, and we can see that we have an increase in both return return amounts and ratios. This is something that we expected. Why? Because as we said, this company was actually being increased from one year to the other. It increased the profit, it increased the investments, but as we can see, when we compare profits to investments, it seems like the profitability of the company or the ability to use the investments to generate profit has been increasing, has been improved. So again, this is a good sign for the activity of the company. Regarding the return ratios, we want these ratios to be as high as possible, and the increasing trend that we notice, it's a good sign for the activity and the performance of the company. Okay, so in case this is clear and no questions, I can continue with the what is known as the return on capital employed disaggregation in compounding ratios. Actually, the return on capital employed can be detailed in two ratios that, when combined together, give us the total return on capital employed amount. That exactly is the margin ratio, the profit margin ratio, and the asset utilization ratio, where margin ratio actually is the ratio between profit before tax plus long-term interest divided by sales, whereas the asset utilization ratio is sales to capital employed. Mathematically, when you combine these two ratios together, sales to sales are simplified, and what you are left with, basically, from a mathematical point of view, is profit before tax plus long-term interest divided by capital employed. So again, return on capital employed is the product between margin ratio and asset utilization ratio. That is that both of them give their impact or effect in the return on capital employed. That means that when the margin ratio is increased or asset utilization ratio is increased, they give us a higher value in the return on capital employed, and that is a good thing. Logically, if you can understand, whenever I have a higher profit margin, or when I have a higher asset utilization ratio, we can have a higher return on common equity. Seldom an entity may have both at the same time, high profit margin and high asset utilization ratios. Sometimes companies may choose to perform at one extreme or at one point over the other. Sometimes companies generate the return on capital employed through higher margin ratios but accepting lower asset utilization ratio. For example, the Carrefour company that we are going to analyze together. Actually, the Carrefour company operates at the other end. They have a high asset utilization ratio. They sell a lot, but applying very low profit margin. Whereas if you refer to other companies, for example, that sell luxurious goods, Montclair, I'm mentioning a fashion brand, they operate at the other extreme. They have a really high profit margin ratio, but still they accept to operate with low asset utilization ratio, so they don't sell a lot. They don't sell a lot of stuff. Still, they generate a high return on capital employed. What I'm trying to say here is that a company usually has an inverse connection between two ratios. Usually, the companies will operate either at a high margin ratio and a low asset utilization one, or with a low margin ratio and high asset utilization. Usually, the same company cannot have both because logically, whenever you increase prices to have a higher profit margin, you will have less products sold, so you will have less asset utilization ratio. So, logically, a company may not achieve both of them, and therefore they choose to operate in either end of this continuum that I'm trying to explain over here. Okay, I explained. Can you think why? Let's continue with ROCE. That is the product between net profit margin and volume trade. Net profit margin, again, is the ratio between the profit before taxes and long-term interest divided to sales. Whenever you hear the term or the word profit margin, that is the ratio between a profit and the sales revenue. Which line of profit it is, it will also give the name to the profit margin itself. Whereas the volume of trade, it's the ratio between the sales revenue and capital employed in this example. If we disaggregate this information, this ratio for the serendipity company that we are explaining together, that we are taking as an example, we will see that the ROCE actually is higher in the second year, but about the specific ratios over here. The profit margin is 8% and it increases in 9.6%. That means that at the second year we are operating under higher margins. We are having more profit for the same amount of sales revenue that we are generating. Whereas the volume of trade is also increased from 1.6 to 1.98, and that's considerable, being a company that has in the same time been increasing the net profit margin. That means that we are selling more. We are not only selling at a higher profit, but we are selling more in the same time. So both of these components, net profit margin and volume of trade, both of them combined together have contributed to the increase of the return on capital employed from one year to the other. Gross profit margin, some more words about that. The gross profit margin is calculated through comparing the gross profit to sales. Remember that the gross profit itself is sales less cost of goods sold. Whereas we have also another profit margin, which is the net profit margin. Remember what I told you, that we have as much profit margins as that amount of profit items we find in the income statement. And the income statement, we find gross profit, operating profit, net profit, retained profit, and so on. So out of that, you can calculate margins very well, always comparing the amount of the profit to the sales revenue. You see something that is really in common through these ratios over there is that they all compare an item of the income statement, being that gross profit, operating profit, or cost of sales. They compare that to the sales revenue. So this is like a common theme in the profit margin ratios. And so when we calculate profit margin, it is better for us, it's easier for us to compare companies together and to understand what is really going on with their operating abilities to generate profit. Of course, we also have efficiency ratios. That means whenever we compare the amount of various expenditures like cost of sales or operating expenditure to the sales revenue, we can understand if we need more part of sales revenue to cover for these expenses or not. So all of these profit margin ratios can give us more insights and more hints to understanding what is really going on with the operating activity of the company. Volume of trade is the second component of capital employed, return on capital employed. Sometimes it is also known as asset utilization ratio, as we mentioned, but again, it's the volume of trade. That means, with simple words, how much money are you generating with the assets that you have employed? You have assets that you have put in use, machinery, plants, property, inventory, and you have put them in use in your activity. How much money are you generating in the form of sales revenue? That is the meaning of the volume of trade or asset utilization ratio. Actually, what is a movement usually done by financial analysts is that they invert the sales to capital employed to another ratio, which is capital employed to sales. And that expresses the value of assets that I need to have invested for each money unit of sales generated. It's another form to express the same thing, but you can use whatever you feel more confident with, so it's up to you. If the capital employed is expressed as the sum of non-current assets, and we will see that with this notation over here, and net current assets with this notation, be careful because they may be very easily confused with each other, so non-current and net current assets, then sales to capital employed could be expressed as sales to non-current assets plus sales to net current assets. And then we can have, after doing this simple division, we can have an expansion of the ratios pyramid in three different levels, as we can see here. At level 1, we have return on capital employed. Return on capital employed could be divided into at level 2, into two different ratios: net profit to sales, and we call that profit margin, and sales to capital employed, we call that asset utilization ratio or volume trade. By dividing the capital employed to non-current assets and net current assets, we arrive at level 3, so having more details about where is coming this rota, where is it coming from, which are the roots of the pyramid over here. So we calculate sales generated from each monetary unit of non-current assets, and then the sales that are generated from each monetary unit from net current assets. We can do the same with the net profit to sales, that is the net profit margin. We can divide the net profit into gross profit over here. Okay, so this is gross profit, and this is the expenditure, the other expenses, operating usually after the cost of sales. So this is something that we can do to disaggregate the return on capital employed and to understand more how is it being generated and why is it increasing from one year to the other. Of course, this belongs to very detailed analysis that we need to do. And usually what we perform in our group work project, for example, or in the exam that we'll have, we are not going beyond level 2. So level 3 is more is for more detailed analysis and usually applied in internal financial analysis. When you are part of a company and you are analyzing that, you have access to detailed information and analytical accounting data. But for the purposes of our exam, group work project, illustrations over here, we are going up to level 2 of the pyramid. Okay, I hope that's easier for you to comprehend and handle. So here where we have the disaggregation of information for serendipity, gross profit margin, as well as cost of goods sold to sales, expenses, not current assets, and net current assets. That is that we have what we see. We have a decrease in the gross profit margin from one year to the other, but the cost of goods sold is increased from one year to the other. They both are related. The cost of goods sold being increased will give me a decrease in the gross profit margin on the other hand. We also see a decrease in the expenses to sales, and this decrease from 25.3% to 20% has more than made up for the increase in cost of goods sold, and that explains the overall increase in the net profit margin. So the problem that we understand here with this company is that actually the cost of goods sold is increasing. And if it was not for the decrease of the other expenditure, the company would probably not have a higher net profit margin, as we can understand from the data or from the information in the company. So again, what we can understand from the disaggregation of information into level 3 is actually sometimes very useful to apply in certain cases when you have the time and you have the intention to understand in depth what's going on, is that you understand which is the source of the problems, if any, with the company. In this case, we see that the problematic area is the cost of goods sold that has been increased. The margin is from 66% to 70%. Okay, and if the same trend continued for the other expenses, operating expenses, we would be left with not an increase in the net profit margin, but with a decrease in this figure. Okay, having said that, having understood the performance of the company, let's go on with the other part of the other end of the pyramid, which is asset utilization, or what we know as turnover ratios. Usually the turnover ratios compare the amount of sales revenue from the income statement to an amount of assets from the balance sheet. Whenever you hear the word turnover ratios, remember sales in the numerator and item of the assets, either total or non-current assets, will be in the denominator. What the asset utilization ratios do is that they try to measure the efficiency of use of assets, and they are actually very industry specific. That means that depending on the sector, you will find different turnover ratios. There are, for example, the retailing industry. They have very high turnover ratios. They generate a lot of sales based in their total assets, but maybe you can also have other industries, like, for example, mining. They have many investments in total assets, and probably the amount of the sales revenue are not as high as in the case of the retailing industry. So keep this in mind. They are industry specific, and each industry will have its own how can I say that, interval, if I can say that, of the asset utilization ratio. Usually they cannot go beyond of what is typical for that industry to have as turnover ratio. Actually, if we want to go in more details in level 3 or even further of the pyramid of ratios, we can fraction the asset utilization into various items of the balance sheet. You see that we start with sales to total assets, but then we know that total assets are the sum of inventory, debtors, current liabilities, property, plant, and equipment, and we can calculate sales to each of them. Remember what I said about turnover ratios. Always, turnover ratios will compare a sales revenue to an item of the balance sheet. And you see that all the turnover ratios over here have the same format. They have sales in the upper part of the ratio, that is the numerator, and I have a different item from balance sheet in the denominator, being that inventory, it can be a short-term assets, it can be intangible assets. So whatever you take and you want to analyze how this asset has been utilized from the company, you can compare that with sales by constructing a ratio of sales to that item of assets for which you want to measure the utilization rate. The pyramid, of course, would expand beyond that level. This is like the complete, sorry about that. This is like the most complete pyramid that we can represent. We have another one, more detailed later. Of course, what I said is that we are going until level 2 of the pyramid. The further details will be left for more detailed and in-depth and internal analysis that you may undertake later. For the purposes of our chapter over here, it is only the disaggregation of ROTA into net profit and the asset to utilization ratio. What can we do with expenses to sales? We can identify 5-6 types of expenditure: expense 1 to sales, expense 2 to assets, and so on. And then we can divide the sales to non-current assets to the 3 components of non-current assets: land and buildings, equipment, and vehicles. So I can see how much sales I'm generating from investing in land or investing in equipment. That is the meaning of this ratio, sales to non-current assets. And then we have sales to net current assets, the third part of the scheme over there. And the net current assets, we can divide to 2 components: current assets and current liability. Net current assets is the difference between both of them. So I can divide and calculate the sales to inventory, sales to debtors, and sales to creditors to know how much sales I have generated through the investments I have done in these items: inventory, debtors, and creditors. So this is the meaning of the ratios that we see there. Of course, the focus will be on efficiency and turnover of current assets and creditors. We can calculate some very curious ratios or indicators, if you may tell that, being based on the 3 last ratios that I mentioned. Remember, sales to inventory, sales to debtors, and sales to creditors, the very last item of the pyramid there. We can use these ratios to calculate what are known as days. Inventory days will be the ratio between average inventory from the balance sheet multiplied by 365 days for a year to cost of goods sold. That would represent the inventory days. How long does it take for the inventory to stay in the warehouse before it is being sold? That is the period of inventory turnover, to express it in different words. Number of days of credit granted to customers would be calculated through trade debtors multiplied by the number of days in the year 365 divided by sales on credit. That would make us, or would help us to calculate usually how many days do the customers take before they repay their invoices or their bills. That is the meaning of this ratio, number of days of credit. Remember that we have to take into account, if we can, of course, in this ratio, only the sales on credit. We may have sales in cash with immediate collection of money. For the purposes of this ratio, it is better to focus on credit sales alone, if we can do that. Another ratio which is mentioned and expressed in days, and therefore it is very useful, it is the time of creditors paid. That means how many days do we usually need to repay our suppliers. And we focus again on the trade creditors, that is trade payables. We multiply that with the number of days in a year and we divide with the purchases on credit. Again, it is advisable to focus on credit purchases, not purchases in cash, but purchases from suppliers with late repayment, not immediate repayment. So these 3 amounts of days: inventory days, debtor days and creditor days are very important for us to understand the cycle, the operating cycle of the company. How many days the inventory is staying in the warehouse, plus how many days do I need before I take the money from customers, and then how many days do I need to repay the suppliers. We will see that this is very useful to analyze for companies and to understand their operating cycle. Have a look at serendipity, for example. We have the number of inventory days reduced from 36.6 to 29 days. Definitely, this is something good for the companies. We want the inventory to stay as least possible in our warehouse as we can. So the faster we can sell inventory, the best it is for us. The reduction in the number of inventory days from one year to the other means something positive for this company. The company is selling inventory faster, that is generating revenue faster, and it is cutting the costs, because keeping inventory in warehouse for long periods usually it's costly for the companies. Have a look at the debtors period. It has been increased from 44 to 58 days. The increase in the debtor period, definitely it is not something good for the company. Why? Because this means that I need more time to collect money from the customers. And having more time or needing more time to collect money from customers doesn't mean something good for the company. In 2024, in average, customers would take 44 days to repay their bills. Okay? But in 2025, they will take like almost 2 months, 58 days. And that is not good for our operations, because we need the money that we collect from customers to inject in our operations and to continue our activity. So again, the reduction in inventory days, it's good. The increase in debtor days, not so good, because that means that we are turning over the debtors slower, and that means less cash and less liquidity for the company. The third one here is the creditors period, that is the number of days I need to repay the suppliers. You see also a very huge increase over there, from 35 days to 57 days. That's something good or bad? That's a question that I have for you. I hope you are not asleep. I cannot see you because your cameras are off. I just see my screen. Sometimes I think I'm alone here, but surely you are following. So here is my question. I'm writing in the chat in case you missed it. Increase in creditors' days is good or bad? Okay, this is a very simple way to pose the question. We have an increase in the creditors' days. Is that good for us, or is that not something good? Francesca, thank you. Gloria, thank you. Good. And if good, why? Because we just said that increasing the debtors period was not good. Okay, why increasing the creditors is good for us? And for us as the company, okay, we are not the supplier in this case. If a simple explanation would be added in the chat, it would help all of us. Good. Thank you for everybody who is writing. Thank you for not falling asleep. I know that the theoretical part of the lecture is a little bit boring before we jump to the exercise, but thank you that you are following. That is something good for the company, because we are delaying the payment to the supplier. That means that this cash is staying in the company and probably the company is using for something else. And remember, this is good because financing from creditors is free and fast, both of them. Taking financing from creditors, that means delaying the payment to the suppliers, is free. There is no interest attached to that. Whenever we take financing from banks, we have to pay interest. But in this case, no interest involved. And then it is fast. It doesn't involve signing contracts, having the approval from the bank management, and so on. So it's fast and free, and it's financing from our activity. Why not use that? So remember, whenever we are talking about assets, inventory, and debtors, The increase in the period, it's not good. The decrease, it's okay. Whenever we are talking about liabilities, the increase in the period of repaying liability, it's good for us. I think that came really clear, so I'm continuing. This is like the performance ratios pyramid. You see that it is very extensive, but please remind that for the purposes of the exam, we are not going until all these details over here. Okay, remember that we are going to calculate the ROTA. We are going to divide that in the profit margin and the asset utilization ratio. We are going to calculate some turnover ratios as well, but I'm not going to require from you to remember the pyramid, like what it does have in one hand and the other. That is something that is supposed to help you memorize the ratios, not something that you should just memorize for the sake of itself only, okay? So this is the pyramid of ratios. Use it as a tool to memorize the ratios, not as a purpose on itself. Okay, we are done, I think, with the performance ratio. So we can jump on the second aspect, which is important for the companies. Okay, I'm very good in performance ratios. I'm performing good. I have high profitability ratio. I have good asset utilization ratio and so on. But at what cost? That means, how did I generate the funds to invest in my activity? Okay, I'm generating revenue and profit and I'm utilizing my investment very well, but what is the way and the means of financing this activity? That is like analyzing the other side of the story or the other side of the coin. A coin has two sides. One side is the performance, it's going good, but the other side, something that we need also to analyze is, where did I find the money to do that? And what is the cost of repaying back that money? In case this is some debt or loan from banks, it has some interest attached to that, and also some other conditions that I have to comply with. What is the cost of the financial structure that I'm really operating at? So the second focus in ratio analysis is going to be financial structure. Where did I find the money? And was that a good and wise decision about the financial structure or not? So whenever we mention financial status, we are looking at that in two different time frames. The short term or the short run, we know them as liquidity ratios. In the short term, so from now until 12 months later, will I be able to cover the liabilities? And the solvency ratios, they focus in a long term perspective. From 12 months in the future until the end, will I be able to cover for these obligations or not? So again, whenever we calculate the financial structure ratio, we focus on short term, in your mind, liquidity, longer term, solvency. Okay, this is something that I like to represent as a compared balance sheet. You know that the balance sheet usually has a vertical form. We start with assets and then we finish with the liabilities and equity. But sometimes you can present assets and liabilities and compare them to each other in order to better understand the maturity of financing and investing. Okay, the asset side represent the investments, and you have two kinds of investments: long term, that is fixed assets, and short term, that is current assets. So the investments or the assets that you are having are two parts or two kinds. Long term, that is the non-current assets, fixed, intangible, financial, and so on. And the short term, which are the current assets. On the other side of the balance sheet, you have liabilities and equity, and they are also divided or represented according to their maturity. Okay, so you start with shareholders' equity and long-term debt, and you see that both of them, they are considered to be long-term financing or long-term funding, whereas the current liabilities is the short-term funding that you are supplying the company with. Sometimes when you compare the sides of the balance sheet, you want to have like a matching between two sides, a matching of the maturity periods. That means this matching of maturity periods means that usually it is advisable from a financial standpoint. It is advisable that whatever long-term funding you are generating, to use that to finance the long-term investments. So again, it is advisable. It's a wise finance rule that we usually follow. Whatever long-term funding you are generating, you better use that to finance the long-term investments. That is, money that you generate from equity or from long-term debt, it's better to use that money to buy machinery, plants, and properties. It's not advisable to buy machinery and plants using current liabilities. That is, money that you have been generating from short-term financing from suppliers. You need to pay back the suppliers in 2 months. Whereas if you use that money to buy machinery, this machinery will give you the returns maybe after 5 years, so you don't have time to generate money in order to pay the supplier. So keep that matched together. Long-term financing will be used for long-term investments. Short-term financing, the bottom part of the comparable balance sheet over here, short-term financing through current liabilities, it's better to be used to finance the current assets. Now you see something else? The current assets are slightly, or not so slightly, higher than current liabilities. That means that whenever we compare the balance sheet together, we would like to find this ratio between both of them. Current assets higher than current liabilities because in the future it is more probable to have a decline in value of the assets than that of current liabilities. In the future, the current assets may be declined in value. For example, part of the debtors maybe you do not collect, they are bad debts. A part of the inventories will not be able to be sold because they are damaged, and so on. Different items of current assets, inventory, debtors, and so they may be reduced in their value with the passing of time, whereas the current liabilities usually in the future do not decline. Usually they have the tendency to increase. For example, whenever you don't pay the interest charge to the bank, you will have to pay a penalty fee over that, so you need to pay more. Having this different tendency in the future, the current assets have the tendency to decrease, the current liability have the tendency to increase. We usually require that each time you compare the two sides of the balance sheet, the current assets should be higher than current liabilities. Okay? So having said that, let's start with mentioning which are the liquidity ratios specifically. There are some very famous ratios over there. I bet those of you that have previously studied economics have gone through mentioning what current ratio is or what quick ratio is, acid test ratio. Both of them, they compare current assets to current liabilities. Remember, they compare the bottom part of the compared balance sheet over there, okay? The current ratio compares current assets and current liabilities, and it should be higher than 1. So what did I mention is that usually we require the current assets to be higher than the current liabilities. Whereas with the acid test ratio, we exclude inventory. You see that it is almost the same ratio between both. The only difference is that from acid test ratio, another name to recognize it is quick ratio, we have reduced it by the inventory. That is, current assets without taking into consideration the inventory. Why do we do that? Usually the inventory is the least liquid item in the current assets. In simpler words, inventory will need or will take a lot of time to be converted in cash. Inventory first should be converted in trade receivables and then will be converted in cash. What if I don't sell this inventory when I want that? Okay, so this is a liquidity ratio. This needs to measure the ability to pay the short-term liabilities. What if the current liabilities over here are payable before I am able to sell the inventory, will I still be able to cover the current liabilities if I don't take into account the inventory at all? So again, this is the meaning of the quick ratio. The current ratio compares all the current assets to current liabilities, and we want them to be higher than current liabilities. That is, current ratio normal value is higher than 1, but we also pose another question. What if we are not able to sell the inventory? So consider the current assets without the inventory. With what is left, will I still be able to cover the current liabilities? Okay, this is the meaning of the acid test ratio. If we calculate these ratios for the company over here, we can see that the acid test for 24 is 1.5 and is decreased in 2025 in 1. Whereas the current ratio, we start with a ratio of 2.2 to 1, and we also experience a decrease over here with 1.4 to 1. That means that this company was actually having a very good performance, as we saw in the first category of ratios, but regarding liquidity, it seems like it's experiencing a decline in the liquidity potential. This does not mean, please be careful, this does not mean that the company is going to be bankrupt or is going to necessarily experience liquidity problems in the future. This is just a trend that I noticed from one year to the other. Remember the benchmarking that we mentioned before? One of the benchmarking was to compare the ratios with the ratios of the previous years, and this is what we are doing here. Whenever we see a declining trend, this does not mean that the company will necessarily have problems, but this is an area that I need to keep an eye on. I need to be very attentive to what may happen with the acid test. It is declining from 1.5 to 1. But in the other year, 2026, it may even go up or increase. So probably this may be a short-term trend and nothing to be worried about, but it's just a red item that I need to keep an eye on for the future. I don't know if that is clear enough. We are just trying to pinpoint the problematic areas. Acid test is decreasing, current ratio is decreasing. Probably that means constraint in the liquidity capacity of the company, but that does not mean that the company will go bankrupt or something like that. Whereas the long-term financial structure is measured and analyzed through the solvency ratios. They are also known as gearing ratios. Solvency ratio is enough for you to remember. There are several ratios over here, and I'm just putting them on the screen and explaining something. You can see that all the gearing ratio or solvency ratios are ratios that are based on the liabilities side of the balance sheet. Keep this in mind because this will help you to interpret and also memorize the ratio. Again, the solvency ratios, the financial structure ratio, they are based on the liability side and they compare with each other some kind of item or section from the liabilities and equity. For example, we compare debt to equity. We compare long-term debt to equity. We compare debt to equity plus debt. This is also known with the name total debt ratio. We also can compare equity to equity plus debt. So whenever we compare some part of item or section from the liabilities part of the balance sheet, we have calculated and represented over there a solvency ratio. Of course, there may be other solvency ratios that are suggested to be calculated, like current liabilities to total liabilities, operating to total liabilities, and so on. Another solvency ratio is the interest coverage ratio. This is a little bit special because it is not focused on the liability side of the balance sheet, but it takes the numerator and the denominator out of the income statement. The interest coverage ratio, sometimes known as times interest earned, that is another name for that, will compare EBIT, so the earnings before interest and taxation, to the total interest expenditure. And that will mean how much do we get or we earn from each monetary unit in interest expenditure. Related to our company, we see that the debt to equity ratio and also debt to total assets has been increased considerably from one year to the other. You see that? So that goes in line with what we said about the short-term liquidity. We had a decline in short-term liquidity, but also we notice here that the long-term solvency is also experiencing some constraints and some problems. Again, this does not mean that we are going to go bankrupt or necessarily have problems with repaying our debts. This is something that we need to keep an eye on because it may become problematic in the future if the trend continues. But for the moment, it seems a short-term trend only. The third category of ratios is the investment potential indicators. These are several ratios that draw not only on financial statements but also, if possible, on some information from the market. Okay, so the first one is what we know book value per share, and usually it compares market value per share with a book value to market value. That means that we take all the book value of the equity, what we have in the financial statement, and we divide that with the number of shares outstanding to see what part of the book value of equity really belongs to each of the shares outstanding. So if you can see, we combine two items, one that we take from financial statements, and that is the ordinary shareholders' equity, with the number of shares outstanding that I have issued and are circulating in the stock market. Another indicator over here is the net dividend. The net dividend is the amount of the dividend declared per share. Actually, the dividend declared per share, or the net dividend, the acronym is DPS, dividend per share, can either be calculated by dividing the dividends to the number of shares, or sometimes the company itself has been declaring this ratio. So usually when you go to the annual report, you will find in one of the notes that for 2020, for example, the company declared a dividend equal to this sum per share. So probably the net dividend will be almost already there in the financial statements. In case it's not, you will need to calculate that. Another ratio is the dividend cover. The dividend cover will be comparing the net profit available to shareholder to the total dividend paid. That is basically what is the profit and what is the dividend. Could we cover the dividend with the profit of this year, or we are using some accumulated retained earnings to cover for the dividend? So again, the dividend cover will compare profit of the year to the dividend of the year. Okay, and we see here through this ratio, were we able to cover the dividend with the profit of the year, or we needed to use some of the retained accumulated earnings as well. Another ratio is the gross dividend yield, which is the dividend that we are declaring basically divided by the market price per ordinary share. That is, for each market price share that a shareholder supposedly is paying to take a share, which dividend is he getting back? So the investor perspective is fully at play over here. From an investor perspective, I would be thinking as an investor buying the share, how much do I pay to buy a share and how much dividend do I get from one share? So this is the dividend yield or the dividend return for me as a potential investor. Another ratio over here is earnings per share. I think we got that covered because we discussed about earnings per share and price to earnings ratio a couple of lectures ago. So at least the two last ratios we have previously mentioned. Again, each of the ratio is specifically explained what does that mean, how they are calculated, and how we can use that in our analysis. Be careful that sometimes we need some additional information. For example, when we interpret the ratio, we need to have an idea about the inflation, because the inflation affects the company. The cash flow throughout the year. Do we have cash inflows or cash outflows more? We have also to use the forecast in the business plans and information in respect of the quality, because we may have very good financial data and profit, but at the expense of the quality of the product. And in the long run, that will have a deteriorating effect on the profit. In the short run, I may have higher profit because I'm offering lower quality products, but in the long run, that is not something that will go on forever. I will experience a decline in the profit because the lower quality product will not be attractive to customers and they will buy less. Industrial average ratios that we mentioned, we can use as kind of benchmark, and also something to consider very carefully, but we are going to have a specific chapter only for that, is the differences in accounting policies. What if the companies that I'm analyzing and comparing to each other, what if they are using different accounting principles? For example, one is using the amortized cost to account for the long-term assets, and the other one is using the fair value method. That would give a really different results regarding the return on equity and the profit margin. What do I do in those cases? We are going to have another chapter later only covering the differences in accounting policies. So about the group work presentation, I think that you really have some job to do now. You will take the financial statements that you are being dealt with and you will calculate the performance ratios, the financial status ratios, and the investor perspective ratios. Does that mean a lot of work? Yes, and this is why in the last hour for today, we are going to work in an Excel spreadsheet to build and prepare a template for you so you can use that in your own companies. Okay, so 5 to 10 minutes break. And after that, we prepare an Excel spreadsheet for all of us. Performance, financial structure, investment, and each of them had more or less 6, 7, some of them even more ratios, which are basically all the ratios that we need to calculate and are part of each of the category, and what is their formula and their meaning as well, if we can say something about the meaning. So I hope that you all see my screen now. I'm sharing an Excel spreadsheet, and later on we are going to have this as a template for your own group work project. And what we are going to do over here is that we are going to mention all of the ratios, their name, first of all, what is put in the numerator and what is put in the denominator. Numerator is the upper part of the ratio and the denominator is the part that is below the line. And then if we need to comment in something and to have something in mind regarding a certain ratio, we will put that over there. Okay, so first of all, the first ratio that we mentioned for today was ROTA, that is the return on capital employed. Are you all seeing the screen? Is that all clear for you? Okay, I'm increasing only the view a little bit. So we can see all the ratio name, what we put in the numerator and denominator. Remember, what we put in the numerator of return on common equity, it was a profit, but we have many items of profit in the income statement. Remember, it was profit before taxes and long-term interest. And something also that we mentioned, sometimes the long-term interest is all the interest expenditure in the income statement, whereas the denominator is what we know as net assets. That is the sum between the equity and long-term debts or long-term liabilities otherwise. So again, we calculate return on common equity by comparing profit before taxes and long-term interest to the net assets, which is the sum between equity and long-term debts. Okay, what is something that we add to the comment? This ratio assumes that only long-term capital is contributing to returns. So something that this ratio assumes is that only when I have long-term financing or long-term capital is contributing to generate profit, or is contributing something to the profitability. Is that a good assumption? Apparently, it's not a good assumption, because except for return on common capital employed, we also have return on assets. And return on assets is calculated with another formula. In the numerator, we take the profit, the EBIT, if you remember. So that is profit or earnings before interest and taxes. Remember that here, right here, we have all the interest amount. And what we put in the denominator is the total assets. So this is what we put in each of the places to calculate the return on assets. Any comments in here? I would say that it's assumed that all assets help to generate profits, or help to generate income and return, and contribute to the generation of returns. Okay, so these are two different assumptions, and sometimes it's useful to calculate both ratios, so I can see which is the return on total funds that I'm using and which is the return only on the long-term funds. Another ratio that we got introduced today was the return on equity, and that is the return on common shareholders' equity. That is calculated by comparing profit before taxes, but after the interest. So this is a line of profit after I have deducted the interest expenditure, but before applying taxation. Sometimes, only for simplicity reasons, we can use earnings after taxes. Be careful with that. Sometimes, only for simplicity reason, only during the exercises, when we do not have complete information, we may use the profit after taxes, or the earnings after taxes. And we calculate that by comparing to the shareholders' equity. That is the shareholders' equity section in the balance sheet. It measures the profitability to the shareholders' investment only. So what would I say about this ratio is that it takes a perspective from the shareholder's point of view. So it assumes that actually what we are trying to do over here is what is the return that the shareholders are having, not everyone. Okay? Shall we continue with the other ratios that we saw today? Remember that we could disaggregate the return on capital employed, or return on equity, and ROA. On the other hand, we could disaggregate into two different components. The first one was the net profit margin, if you remember, and the other one was the volume of trade, or the asset utilization rate. Remember? So again, ROTE was the product between net profit margin and volume of trade. I'm putting right here ratio 4 multiplied by ratio 5 that we have a little bit later. So again, what was the net profit margin comparing? It was profit before taxes and long-term interest. That was the line that I would put in the numerator, and I would calculate and compare that to sales revenue. Sales revenue is an item from the income statement. No comment on that. I think that's pretty clear. Whereas the volume of trade, or sometimes known as assets, in this case it was capital, capital turnover. Okay, so the volume of trade is actually sales revenue compared to the capital employed, where the capital employed, again, we may need to add some comments here. Capital employed may have different appearances or manifestations, like it may appear as either total assets, sometimes, as we saw even before in the various forms of return on investment. Net assets sometimes, or even it can be shareholders' equity. So the capital employed may be either one of them. The denominators of the previous ratios over here. As you see, it depends a lot on what we assume to be the amount, what we assume to be the amount of the profit and the amount of the investment that we take into consideration. Any questions so far? Regarding, again, what we are doing is that we are taking every ratio that we mentioned and we are putting that on an Excel file so we can use that as a template to facilitate the calculations in our exercises and in our group work projects. Another ratio that was mentioned was the gross profit margin. Gross profit margin was calculated by dividing gross profit. Again, gross profit was equal to sales less cost of goods sold. This is the gross profit. We could normally compare gross profit to the sales revenue. Always, when you have a profit margin, the denominator will always be sales revenue. So this is gross profit margin. As an acronym during our lecture, it was GP to sales. So to link the Excel file with the PowerPoint presentation, this was the acronym that is used during the explanation over here. We had an efficiency ratio. Actually, we have two of them. So efficiency ratio 1 and efficiency ratio 2. And actually, what do they measure? The first one measures cost of goods sold to the sales revenue. So what is the ratio between them? It is known as efficiency ratio 1, focused on cost of goods sold only, because it is considering how much or what is the part of the sales revenue that I need to cover the cost of goods sold. The acronym that was used in the slides today, it was, of course, cost of goods sold to sales. And the second efficiency ratio 2, was focused not on cost of goods sold, but if you remember, in the income statement, the other very important expenditure are operating expenses. That is selling, administrative, and so on. So this is focused on operating expenses, and obviously it will compare operating expenses, selling, general, administrative, everything like that, to, of course, sales revenue. Remember that the margins and the efficiency ratios always compare a figure of profit or an item of expense or an item of income to the revenues. The acronym that we use, the acronym that is used to represent the efficiency ratio number 2 is expenses to sales, where expenses were, as we said, of course, the operating expenditures usually. Any questions so far? So again, what we are doing is that we are preparing an Excel file to have for our future uses. Okay, another ratio over here is total assets turnover ratio. Okay, so whenever you hear the word turnover, you should always have sales revenue in the numerator. So sales here are compared to total assets. And anything to say about that? Nothing, I think, no comment. Total assets turnover actually compares the sales to total assets to know or to understand how better, how good or not good the total assets are utilized, are used by the company. So sales to total assets. We are still at the first category of ratios. These are all performance ratios that we are showing over here. Remember? So the other categories will be most more reduced in number, but for the moment we are representing only the performance ratio. And remember something else, we are not going until the lower part of the pyramid of ratio. Remember that we are just representing the most important ratios over here. Another important turnover ratio that we can calculate was the inventory turnover. Always, whenever you compare the turnover, or whenever you calculate the turnover, you will compare sales to inventory. Whenever it is possible, use average inventory. Okay, I will take the chat in the moment. Average if possible. That means opening balance inventory plus closing balance of inventory divided by 2. Okay, we have something in the chat. Let's take it. Yes, actually, it should be the difference between both of them. So net profit margin, it should be the difference between the two, let's say, efficiency ratios. Gloria and the others, be careful, because sometimes in real cases, in real world companies, we will see Carrefour in just some minutes later. You will see that the income statement is not so summarized. You will have many items there, not like serendipity example that was very clear, very concise, very academic like. In real words, you will have income statement with many items, and we need to know how to use that information. Okay, so theoretically it should be like we are saying there, net profit margin equals the difference between both, but sometimes you may have some items in the income statement, like for example research and development expenditure, that they are not part of the cost of goods sold or selling or general. So again, please keep in mind that theoretically it should work. Basically, in reality, you will have a variety of conditions that exist over there. So again, let's continue. Something to say about the inventory turnover, something to mention. Yes, I would like to add something here. You see that this is the division or the ratio between sales and inventory. Better to use cost of goods sold instead of sales. So sometimes it is better that right here in the numerator, instead of sales, you put cost of goods sold, because this way, I'm putting the interpretation why, because this way we have both elements of the ratio, both numerator and the denominator, measured at the same basis of valuation. What do I mean about that? Remember that we have to keep in mind, whenever we calculate a ratio, it's better to have both components, both elements, numerator and denominator, measured at the same valuation basis. Now, if I use the sales figure over here, sales are measured through the selling price. Whenever inventory, as we saw through IS2, is not allowed to be valued through selling prices unless it is net realizable value. Inventory is required to be measured through cost of production or cost of purchasing. That means that it's a better logical approach to use cost of sales comparing to inventory rather than sales. Does that make sense to you? So again, calculating inventory turnover, it is advisable to use cost of sales for the purposes to have a better representative ratio over there. Okay, right after the inventory turnover, we can calculate what we recognize as inventory days. Remember that the number of inventory days is represented in number of days actually, and it will be average inventory, if I may calculate average, or rather I would be based in my calculation in the ending balances, average inventory multiplied by the number of days in a year and that would be divided by, as we already discussed, with cost of goods sold over here. So this is the number of inventory days. Average inventory possible? Possible. If not, closing balance inventory would give an acceptable value or a logical value to start with. Another ratio over here is the debtors days. If you remember, we mentioned that it is very important to measure the number of days inventory needs to be sold, number of days we need to collect money from debtors, and number of days we need to pay to our creditors. So debtors days, actually it is calculated after I calculate the debtors turnover, of course. So I would have here the figure of sales calculated or actually compared to average if I can. If I can't, is the previous discussion. Average debtors over here, or as we also knew that is account receivables or trade receivable. Okay, something that I need to mention here, if possible, and if we have information, only sales on credit should be taken into account, okay? And to compare them to the trade debtors, okay? So if possible, only sales and credit should be taken into account and only trade debtors. That means that sometimes we have debtors for other reasons, for example, debtors for selling fixed assets or debtors from other reasons. And so we should pay attention whenever we calculate the debtors turnover. If I have the possibility to take into account only the sales, that would be good, the sales on credit. If not, then I would base my calculations on total sales. And regarding the debtors, if it is possible to know only the trade receivables, and that is something that I easily can find in the notes of the accounts, in the financial statement notes, then I should take into account only the trade receivables or the trade debtors. The debtors days, it's similar to the inventory days. So I start with average, if possible, debtors, average trade receivables. We multiply that by 365 days in a year, and we divide that by sales. This is the debtors number of debtors days. So this is divided by sales revenue. Of course, average, if I can, and what is average, we also mentioned, the opening balance. Sorry about that. Okay, so average debtors is equal to opening balance of debtors plus closing balance of debtors, that is divided by 2. Why do we sometimes suggest that we use the closing balances only right here? This is the moment to mention something. I say average, but sometimes we mention that we cannot base our calculation on average values. If we would base the calculations on average values, it would not be possible for us to use the trend or the comparison with the previous year, because we would need an extra year to calculate the average debtors for the previous year. So sometimes it's just easier to base the calculations on the closing balances. 2 more ratios in the profitability section, and then we are done with this, and we may continue with the liquidity and solvency ratios. Right here, ratio number 14 is the creditors turnover ratio. The creditors turnover actually compares cost of goods sold in case I can and I have the information, it's better to use the purchases of inventory, sorry, not purchases of something else. So we compare the cost of goods sold to the, if we can average, as we said, average creditors or average trade payables, account payable as we recognize them. So again, cost of goods sold, or if I can, the purchases, if don't, just go on with the cost of goods sold, is compared to the average creditors. If financial statements represent the amount of the purchases, go with that. If not, go with the cost of goods sold. It should be like the same thing. And again, remember that regarding the creditors, only the trades account payable is better to be taken into account. Why is that? Because of the same reason. Part of the creditors, we can also find some other items that are not related to the primary activity of the company. For example, we may have accounts payable related to purchases not of inventory, but purchases of fixed assets, and we have to pay them later. For the purposes of creditors turnover, we need to be based only on the purchases of inventory as part of merchandising activity. And of course, the last ratio over here is the creditors days, number of creditors days. That means how long do I take to repay the suppliers? It relates to the discussion that we already did in the first part of the lecture today. Regarding the creditors days, we calculate the average creditors multiplied by 365 days. So the average creditors, if I can, of course, we compare that to the cost of goods sold, and if we can, to the purchases, if we have this kind of information. So again, what does that represent? Number of creditor days. It represents how long do we take in average, always, to pay the suppliers. Only the suppliers of the inventory. Okay, so we are done, I would say, with the first category. Let's have a look what we did. I'm just having a summarized effect over here. You see the performance ratios are in total 15 ratios. All of them have a formula, all of them have a meaning, and we need to calculate that for our companies. Of course, you are 5 or 6 persons in each group, and you may divide the work. You may have to divide the work between you. Some will calculate the liquidity, some the solvency, some the return ratio, and so on. So let's continue with the second category of ratio, that is the financial structure. I have identified 7 ratios over here. The first one is the current ratio. The second one was the acid test ratio. Another name for that was quick ratio, if you remember. And then we continue with the others. But first of all, let's show what is the formula for the first 2 ratios. If you remember the current ratio, we said compares the current assets to current liabilities. And something that maybe we need to add to the comments for this ratio is that it should be higher than 1 or 100%. This depends on the way we are representing this the value of this ratio. So again, the current ratio means that we are looking to have current assets higher than current liabilities, and that is why we are looking to have a value of the current ratio higher than 100. Whereas the acid test ratio starts from the current assets, but it deducts the inventory. And again, it compares that to the current liabilities. Now, the meaning of the quick ratio means quickly, if I do not have to sell the inventory, because that is like the least liquid item among the current assets. If I cannot and I need not to sell the inventory, can I still repay the current liabilities? Again, Darcy test ratio. Sometimes it is required to be higher than 100%. Another ratio that we have over here is the total debt ratio. It compares total liabilities or total debt from the balance sheet to total assets. So that is the formula that right here we use to calculate the total debt ratio. Now, I need to add some comments about this ratio. Usually, in the past, traditionally as well, if I may add that, usually and traditionally, this ratio is required to be around 50%. Now, why do I say usually and traditionally as well? Because the ratio 50% is like a average value that represents the equilibrium between being financed from outside sources and being financed from inside funds. So when I calculate the total debt ratio, total liabilities to total assets, I want this ratio around 50%, and that means that half of the funds are coming from debt and half the other is coming from capital or equity. But, and this is a big but over here, but this depends, the normal value, this depends on two factors. Number one is the sector or the industry where the company is operating. Why do I say that? Usually when you analyze the total debt ratio and you are doing the analysis for some financial company, for example, for a bank, you will find that the total debt ratio could be among 80-90% without being too risky. So we acknowledge the normal value to be 50%, but if we are dealing with a financial company like a bank, the total debt ratio can be 80%, but that's okay for this industry, for this sector. So one factor to really affect your explanation is the sector and the industry where the company belongs. And the second factor is the risk profile of the CEO or the owners, if I may say, or the managers of the company. What does that mean? The risk profile is something between risk acceptance and risk decline. You probably have made this discussion before. Sometimes people are against taking risk. They are very cautious and they are very conservative. They do not like to have high amount of debts. Whereas some other persons are risk acceptive. They want to operate under risk. There is nothing wrong with that. Both types of persons have this like risk profile for them. Nothing wrong with any kind of person, but only the outcome will depend. When we have situation with an increasing gross domestic product, or we have an increase in the average economic conditions, usually the risk acceptance individuals and companies, they will earn more money than those that are risk aversion or risk do not want to undertake risk. Whereas when we have situation that the economy is not so good, usually the person that are very conservative and risk aversion, they will lose less money than the persons that are undertaking a lot of risk. So whenever you calculate and interpret the total debt ratio, keep this in mind. what is the profile of the risk for the persons involved there, okay? So this is one ratio that relates to the financial structure. Another ratio is debt to equity ratio. You see that this is a name that implies the formula itself. So what I actually calculate is total liabilities to total equity, and total equity is directly received from the financial statement of financial position. Okay, so this value, it should be traditionally and usually, as I said, around 100%. If the total debt ratio is 50%, this should be 100%. Another ratio over here is long-term debt to equity. As you can see, we can have different arrangements between different items and sections of the liabilities in the balance sheet. Of course, what we compare over here is long-term liabilities to equity. Okay, so this is another ratio that we can calculate. Nothing to say about its optimal value, so we can continue. Another ratio over here is equity to total assets. You see that it's curious that the name itself implies the formula. So basically what we do here is that we compare the equity to the total assets of the company. Again, this is part of the long-term solvency financial structure assessment ratio. And the last one that we need to cover over here, don't remember the interest coverage ratio. That means, okay, I'm having some debts and loans, but I also need to pay interest on them. So how much can I cover? How far can I go into covering the interest needs for these debts? It is also known as the interest services or loan services ratio. So basically what we calculate over here is earning before interest and taxes, EBIT, otherwise is known as EBIT, to total interest expenses. Now be careful here in this ratio because it should be between, just let me move it should be between 5 to 8 times to be considered normal. That means that usually when I calculate the interest coverage, I need the EBIT, the profit before interest and taxes, to be at least 5 to 8 times higher, bigger than the total interest expenditure. Of course, it can have other values, but you should require usually this ratio to be in this interval, in this range over here. Something else that I need to add in the comments. Interest expenses only. That means do not add in there other finance costs, commission, interest rate, conversion costs, and so on. They are all financial expenses. But what we are interested in here is only interest expenditure. So pay attention to the financial statement, income statement. Whenever you have other financial expenditure, do not take them into account. Only interest expenses should be taken into account over here, okay? So again, we finished with the second category of the ratios, and right now we are at the last one. So some more minutes of work for us. The first one is book value per share. Now, basically, what this ratio does is that it compares the shareholders' equity amount, so the total shareholders' equity. It compares that to the number of shares outstanding, because we may have number of shares in issue, treasury, and so on. But this is only related to the number of shares outstanding. What do we use that information for? We usually compare this to the market price of the shares. Now, remember that what we are doing over here, we are calculating what part of the shareholder's equity, the accounting value or the book value, belongs to each of the share that we have outstanding. It's a good measure to compare to the market price, and so we can understand the overpriced or the underpriced share. So this is something that we can use this ratio for. We can calculate that and compare to the market price to see if it is being traded, this share is being traded in market with a higher price than the accounting value really implies. The second ratio here is dividend per share, or with an acronym DPS, declared dividend per year in a certain year to number of shares outstanding. So again, it is dividend per share and is obviously calculated as the ratio of the dividend to the number of shares. Now, have in mind, careful here, and I have to write that, usually the declared dividend of 1 year is paid the next year. So this is why we are trying to make the distinction between, okay. So careful, usually the declared dividend of 1 year is paid the next year. What we declare as dividend in, for example, 2020, you are going to pay that in 2021. Okay? So let's continue. 4 more ratios here and we are done. Don't forget that we have a dividend cover mentioned as a ratio over here. It is equal to the net profit available to common shareholders. So net profit available to common shareholders to the total dividend paid. Now you see that there is a distinction between declared dividend and dividend paid. In case you can have the information and the difference between both of them, you can put them in here, but sometimes you just assume that declared dividend and paid dividends are the same. In case you do not have information, you can assume that paid and declared dividends are the same. So we have this simplicity in our calculations, okay? In case you do not have information, you can assume that paid and declared dividends are the same amount. So nothing to add in this case to the dividend cover. Of course, we can show with that, as we said during our interpretations, how much we can cover the dividend through the profit of the year. It shows how much, at what extent the dividend is covered through the net income of the year. Okay? It becomes clear that if we do not cover the dividend through the net income of the year, we have to use the retained earnings reserve, which is not really desirable. Okay, right here we have a gross dividend yield. That is a purely, as we mentioned, from an investor perspective. That is dividend per share. How much dividend do I get per share? That is ratio number 2 over here. Divided to the market price per share. How much did I pay to get 1 share and how much dividend I'm taking from this share? So is equal gross dividend, usually it's equal with dividend divided by 1 less tax rates. as dividends are paid after taxes, if you can do that. Okay, so earnings per share, we are almost at the end. Earnings per share is the ratio over here, and we know that we divide net profit available to common shareholders to the number of shares outstanding. And I'm not adding any comment because we really know very well this ratio. And the last one is price to earnings ratio. Basically what it does is that compares earnings per share, sorry, this is the denominator, my bad. So it compares market price of shares, it compares to the earnings per share. Now, what does it represent? What does it show? This last ratio, it actually represents the market's perspective of the growth potential of each company. Okay, so as we said, price to earnings combines something that comes from the company, that's earnings per share, company's financial statement, and the market price, which comes from the market itself. So I know it took a long time, but now you have this template ready. That means that we will share that, and you can use that to calculate the ratios for your own companies. There are a lot, but still you need to calculate and interpret them. And also we will add during the other chapters, we'll add some other ratios into that, but for the moment, I think that's enough. So these are the formulas. In the first sheet that you have here, we went together through the formulas again, so that was a way to memorize better the formulas of the ratios. Remember that for the purposes of the exam, we have to know the formulas, and we have to know not only how to calculate each ratio, but also how to interpret every one of them, okay? So probably hopefully, this was something that proved helpful to you, okay? So what does the second sheet contains? Do not be afraid of what you find here. I prepared something that will come to your rescue. For the moment, do not pay attention to this. Now, you see that we need, in order to calculate and to use these formulas, we need to have some data, okay, from the financial statements. But when I'm referring to a real case, to a real world company, the financial statements are not so easy to interpret. For example, okay, where is it? Right over here. Please let me know if you can see in your screens the financial statements of Carrefour Company. Okay? I'm just showing you how complicated, in case you don't know, but I think that you already know that. I'm just showing you that actually the financial statements are not so easy to understand. They have many items. They are not so constrained and summarized, okay, as the one that we take as examples. For example, the income statement of Carrefour Company, they start with net sales, and then they have some items, loyalty program costs, net sales, net of this cost, which is included in the sales, other revenue, and then we have total revenue amount, okay? So in case I need to take into account the sales revenue, which is one basic element to calculate the ratios, which one is necessary to include there, okay? Then we have cost of sales, then we have gross margin, then we have operating expenditure, then we have recurring operating income. I think Gloria asked the question, is that equal to that? And I mentioned, be careful, sometimes in real companies, you may have some items that do not make it easier to jump from one known item to the other. So this is the case. I have a very detailed income statement over here. How can I use the information? If I go on, I also have a lot of information in the comprehensive income. I have a lot of information in the consolidated statement of financial position as well. How do we use that information? How do we include that in calculating the ratios that we mentioned? Now, in order to not be confused and work easily, I have prepared an Excel file where you have just to insert the data. Please do not add any rows, do not add any columns, you just put the information over here. For example, if I would start with the net sales, okay, the net sales amount is the one that I have put in the both years, 2020 and 2019. So the net sales is the first amount over here. Then I have inserted the cost of sales, totally skipping the other items. You see that I have not taken into consideration total revenue. I have considered here only net sales revenue, okay? So not total revenue, revenue from other sources. Then I have inserted cost of sales, then I have inserted gross profit, then I have inserted operating expenses, that is over here. Then finance cost, but be careful. Regarding the finance cost, there are several items over here. I've included only the net finance cost, not including the lease commitments or other financial income and expenditure. So that means under the finance cost, we have only interest expenditure, which will be useful later. So again, I'm putting the real income statement over here for you to have a look and understand why we are just including in the data sheet only the most basic information that we need. No need to include all the income statement. And again, we do the same with other information. You see, regarding the balance sheet, I have not put the balance sheet all together over there. I just inserted the necessary items that we will be needing in order to calculate the formulas that we mentioned. For example, of course, I will need non-current assets and current assets. The sum of them gives me the total assets, but in between I would need debtors or trade receivables from clients and inventory. Be careful. Trade receivables, only those related to the trading activity. That means that what I find in the balance sheet, let me share with you again, the balance sheet of the Carrefour company. What I find in the balance sheet of the Carrefour company. Do you see my screen right now? Okay, now you can see, I hope, my screen. What do we see in the shareholders' equity section? We should be in the assets. Okay, now what we can see right here at the current assets, you see trade receivables, okay? But trade receivables over here are not related, all of them, with the trading activity. So I have really checked very carefully note 6.4 and found the exact amount of the trade receivables linked or related to the trading activities. So again, be careful to pay attention to several items, but also to the notes in the financial statements. For everything, I've left a comment in every cell. Note 643 in the financial statement. So again, we have not included all the balance sheet, but only those items that are really important. Okay? The same with the liabilities and equity. I've put it here, total shareholder equity, non-current liability, and current liability. The total represents the total of the balance sheet, but also the amount of the suppliers trading payables is important. Other pieces of information that we need to refer to are the number of shares. Remember that it is needed for several ratios in the last category of investment ratios. The amount of the dividends and the market price per share. I've inserted clarifications for each of them. Number of shares is represented in the statement of changes in equity and note 13.2. Each of you can find in your own companies where this information is going to be found. The dividends, we can find that in the statement of changes in equity. Whereas the market price per share, I've just checked Yahoo Finance without thinking about any other website. Please be aware that depending on where you find the information, you can have different market prices for the same company for the same date. Yahoo Finance or Google Finance, usually they use some trailing average for 7 days or 15 days. It doesn't matter as long as you are consistent with the source of your information. For example, I'm referring to Yahoo Finance, the 1 day price, 1 day closing price only. Okay, so after we insert the data, the ratios are over here in the last spreadsheet, automatically calculated. You have the formulas ready, students. You have the ratio name, the numerator, the denominator, and the formulas for both year 2020 and 2019. That means do not add any rows, do not delete any rows or columns, okay? So I'm writing that in the chat. If you do that, if you do not delete or add any rows or columns in the second shift data over here, you will not have any problem to use this Excel spreadsheet because all the ratios and their formulas that we have over here, if you see, for example, in one cell, if you click there, all the formulas are inserted and are related to the sheet data. So please do not make any changes in that sheet, so it will not be difficult for you to apply these templates, okay? Any question so far? Something you need to ask before you continue? I will post the Excel file on Moodle as soon as I can. You can use it. You can use it for your group project, okay? Just take your company, look at the data that you have there, insert the data over here in the second sheet, the amount, do not add any row, do not delete any row, or unless you can do that, but you have to fix the formulas again, and then you will have the results over here. The next thing you need to do is to interpret the information, okay? Any questions, sir? Yes, Victoria, I'm sorry, you need to know all the formulas for the exam. So you need to know the way they are calculated. Of course, you will not be asked for all the ratios, okay? But you need to know them and also their interpretation. Probably you will be asked for 4 or 5 out of these ratios, but still you need to know them all. So yeah, this is something that you need to learn. That's why I really spend a lot of time to mention their formulas and the meaning. Usually if you try to understand the meaning of a ratio, it is not difficult to remember the way it is calculated, okay? So of course, minor changes I can understand in case you, for example, you don't take total sales, but sales on credit only, or vice versa, I can understand that. But in general, the formula, you should understand and try to memorize that, okay? Okay, so we are done with today's lecture. Tomorrow is a day off, no lecture for tomorrow. Of course, I can understand based on previous year experiences, I can understand that you will start your group work project trying to calculate the ratios using the Excel file, and you feel free to ask me through emails or through Moodle at the chat section over there. Please feel free to ask for anything that is not certain to you. Tomorrow is a day off. The day after tomorrow, on Friday, we will see each other to continue the discussion about the ratio analysis. Today, we discussed about basic ratios, and we will supplement the ratios with some other new indicators on Friday with the next chapter, that is chapter 31 in our textbook. So, we started today with the ratios. We still have some new ones to think to learn about on Friday. So that is something that you need to go through. I know it's not easy to memorize all those ratios, the formulas and the meanings and the interpretation, but financial statement analysis is really important in this point to be based on the financial ratios. Okay, any questions? I don't think you have any, at least for the moment. So any time you have something to ask, feel free to contact me. For the moment, goodbye and see you the day after tomorrow.